what if I told you that there's an ETF that not only outperforms the overall stock market, but also blew away the returns of the NASDAQ 100 ETF QQQ and the tech sector ETF VGT? And in this video, we're diving into SMH, the VanEck Semiconductor ETF. I'll be breaking down everything about this ETF, along with what to look out for in the future, so you can decide if this powerful ETF fits into your investing strategy. The first thing you need to understand is that the chip and AI revolution is happening right now. Take a second and think about the different things that you use and see on a daily basis, like your cell phone to text, call, and use apps, or asking ChatGPT a question about something that you don't understand, or the cars that you see on the road, whether they're EVs or not. Every one of these things are powered by semiconductors. And what many people don't realize is how semiconductors have become a core component in just about everything that we use. And this is why the big tech companies plan to spend over $600 billion on AI-related CapEx in 2026, as the push for AI is not slowing down anytime soon, with the drive towards autonomous vehicles, robotics, agentic AI, and more. And global semiconductor revenues are expected to pass $1 trillion in 2026, marking a huge milestone for the semiconductor industry. This expansion into AI isn't something that's far out into the future, it's all happening right now, and this is why you have an ETF like SMH, which allows you to have focused exposure to companies in this rapidly expanding industry, all in one basket. So how does SMH actually work when it comes to the stocks that make up this ETF? SMH tracks the NVIS US-listed Semiconductor 25 Index, which includes companies that are involved in semiconductor production and equipment. And it's not a random collection of semiconductor stocks, as it has a specific selection criteria. First, to be considered for this index, a company must generate at least 50% of its revenues from semiconductors or semiconductor equipment. So you're getting companies where semiconductors are part of the core business and not just a small segment of their overall business. The index also has specific size and liquidity requirements for the companies. By this I mean companies must have a market cap of at least $150 million and a 3-month average daily trading volume of at least $1 million. And there's one limitation in place, which is that no single stock can make up more than 20% of the total portfolio. The fund is also market cap weighted, and the index is rebalanced quarterly and reconstituted twice a year in March and September. Now that you understand the strategy, what are you actually buying when you invest in SMH? SMH has around $43.5 billion of assets under management, so it's a pretty decent sized fund. And it comes with an expense ratio of 0.35%, costing you $35 yearly for every $10,000 invested. So a little bit higher than some of the low-cost fees that you're likely familiar with, but the performance easily makes up for it. For the portfolio, SMH contains only 26 holdings in total, so it's very concentrated. And for the top holdings that make up the fund, the largest is NVIDIA, which makes up a big chunk. And this isn't too shocking considering NVIDIA is one of the leading companies when it comes to AI. Second on the list is TSMC, or Taiwan Semiconductor Manufacturing Company, and they produce the chips for NVIDIA, AMD, and others. And then you have Broadcom, ASML, and others, which these top 10 stocks make up almost 75% of the total portfolio. So it's definitely pretty top heavy, which is to be expected from the concentrated amount of holdings that it has. And while this ETF is very concentrated, it gives you exposure across the whole semiconductor ecosystem, and I'll be explaining some of these key segments since it's important to have a general idea. So first, you have fabless designers like AMD and NVIDIA. And fabless in the semiconductor industry are companies that design and sell semiconductor chips, but do not own the manufacturing facilities that are known as fabs, where these chips are produced. So they're focused on the design and innovation in the architecture, and then they outsource the production. And then you have foundries like Samsung and Taiwan Semiconductor, and these foundries are the manufacturers. So they're the large factories that fabricate semiconductor chips for other companies. So no designing, just manufacturing. Then there's the manufacturing equipment makers such as Applied Materials and ASML. These companies build some of the most complex and expensive machines that are physically used to manufacture semiconductors. For example, ASML is the only company that makes extreme ultraviolet light or EUV technology. And their EUV lithography machines cost over $300 million each, which is pretty insane. And you also have IDMs, or integrated device manufacturers, like Samsung, SK Hynix, and Micron Technology. These companies design, manufacture, and sell their own chips so they can handle the full process of designing to fabrication, so they're vertically integrated. Those are some of the core parts of the semiconductor ecosystem to give you a better understanding of what all SMH is made up of. And while this focused exposure and concentration does come with higher volatility and risk, it also comes with high potential reward when the industry is really taking off, which we'll be getting into next. What stands out the most for SMH is the performance that it's had over these years. So let's get into the returns and how it compares to some of the top performing ETFs like QQQ and VGT. Growth and technology stocks have had strong returns over these last few years, and it's the reason why the stock market overall has been doing so well. And when it comes to ETFs that have outperformed the market, you're likely to hear about Vanguard's Technology Sector ETF, VGT, or the Invesco NASDAQ 100 ETF, QQQ, that tracks the top 100 companies, excluding financials. Now, since they've done so well, it's only fair to line them up against SMH. SMH was created a little over 14 years ago in December 2011, and since then, it's had annualized returns of nearly 27%. That's right, 27% annually, which is crazy to think about. But let's take a look at the last 10 years compared to VGT and QQQ. SMH has had total returns of over 1,700% in these last 10 years, which is over 30% returns annually, while VGT, a broader tech ETF, had over 700%, and QQQ, the NASDAQ 100 fund, came in at about 544%. Now, SMH had so much growth, it made the others not seem as significant, but when you look at the bigger picture compared to an S&P 500 ETF like VU, you can get a much better idea of the level of outperformance that SMH has had. If we close into the last 5 years, SMH has had nearly 240% in returns, so it's provided around 27% or so of annual returns in that time, still doubling that of VGT and QQQ, which was over 100%. And if we zoom in to just over the past year, you can see how much momentum these semiconductor stocks have been picking up recently, with SMH nearly crossing 60% in returns. SMH has been in another world when it comes to its performance, but it hasn't been a smooth ride. While SMH offers solid growth potential, it does come with more volatility and higher drawdowns. When it comes to the beta over the last 10 years, QQQ has a beta of 1.11, VGT 1.18, and SMH has a beta of 1.43, making it much more volatile than the overall market, which has a beta of 1 and also much higher than the other ETFs. Now let's take a look at the largest drawdowns for each of these ETFs in the last 10 years. This brings us back to 2022 when the stock market took a hit and tech was hammered even harder due to recession fears, inflation, and increasing interest rates, where QQQ had a drawdown of about 32.5%, VGT also around 32.5%, then SMH with the largest drop of around 40%. So while SMH has done well, it's important to consider the volatility and risk that this fund comes with because it can have pretty drastic swings. While SMH has offered some incredible returns since its creation, looking into 2026, is this something that can continue? This is a tough one to answer since I don't have a crystal ball, but there are some positive trends to consider for 2026, along with some possible headwinds that we may face this year. So let's first get into the positives that we have for this year. First is that the adoption of AI is only picking up steam and not slowing down. The total usage of LLMs like ChatGPT, Gemini, Claude, and others is rapidly expanding. AI is slowly beginning to change how companies operate by improving decision-making, accelerating software development, and enabling more personalized customer engagement. This leads me to the heavy spending in AI-related capital expenditures. Hyperscalers like Google, Amazon, Microsoft, Meta, and Oracle are planning to increase CapEx by over 40% year over year in 2026, which would be over $600 billion. With the high demand for compute, this is fueling huge investments into AI infrastructure, from chips to data centers and connectivity. Now, we're early in the year and earnings season is just starting to kick off, but TSMC, or Taiwan Semiconductor, recently had earnings which helped to validate the level of demand. TSMC crushed Q4 earnings with profits of around 35%, beating out forecasted estimates. And they expect revenue to jump nearly 30%, and they plan to increase CapEx spending from around $40 billion in 2025 to $52 to $56 billion in 2026, so nearly a 37% increase in spending. While they expect demand in AI chips to continue for years, TSMC doesn't represent the entire semiconductor market, but it's helping to support the continued proof of high demand. And hopefully, this shines some light on what to possibly expect from other companies in the semiconductor space, along with AI and AI adjacent companies. But that doesn't hide the fact that there's still some risk in the market. I think one of the main things to highlight is the concern about the ROI of heavily investing in AI and the high valuations that come with it. Many of these semiconductor stocks have had really great returns, not only due to the solid earnings growth, but also how much future expected growth has already been priced in. Because the big question that's brought up is whether or not companies like the big hyperscalers can produce reasonable returns and profits from these big AI investments. And we're in the early stages, so companies have yet to see any meaningful impact to productivity and profitability, but either way, this will play a huge part into SMH's performance. Another headwind for the year is trade tensions affecting the semiconductor supply chain. The supply chain of chip production is fragmented and highly concentrated in a handful of countries. What I mean by that is, if we take a look at this table, you can see there's key stages of production that stretch over a variety of countries. And this shows how vulnerable the semiconductor industry can be to any policy changes, tariffs, geopolitical issues, or disruptions in the supply chain. These problems won't just hurt one specific company, but likely multiple points within the chain. This last headwind for 2026 is the risk that comes with SMH due to its heavy concentration. With this ETF only holding 26 stocks in total, and the top holdings making up 3/4 of the portfolio, that leaves a lot of opportunity for things to go sideways. With the variety of different issues that I mentioned could affect SMH this year, a drop in some of the fund's larger stocks could have a huge impact. For this reason, I wouldn't look past the chance that there could be some volatility or a larger drawdown, given the level of uncertainty that could come with issues outside of company performance, like trade issues, geopolitical risks, interest rates, and other macroeconomic events that could play a big part in affecting the semiconductor industry. So, should you invest at all in SMH? Like any ETF or any type of investment, it ultimately depends on your investing strategy and investor profile. But there are a few reasons why you might want to think about picking up this ETF. One reason that makes sense is if you're looking to have exposure to the semiconductor industry without having to try and pick who the winners are going to be. Second is if you have conviction in the AI theme that the expansion and investment into AI and AI infrastructure is worthwhile and that it will provide more productivity, efficiency, and innovation to a wide variety of products, services, and businesses, and also become more intertwined in our daily lives. Also, if you believe that SMH will continue to offer solid growth potential due to the growth that comes with the expansion in AI and AI infrastructure. Now, this doesn't mean that it'll be a smooth ride up for growth, but you should be aware and comfortable with the volatility that SMH comes with. And also, if you're looking for exposure to an industry to boost the growth potential of your portfolio. If this aligns with you, along with having a positive outlook for the industry in 2026 and beyond, then SMH is an ETF that you may want to consider. But if you're someone who won't be able to handle the high volatility, or you don't have much conviction in the industry or in the near term, or you're looking for a more diversified fund or something that provides income, then this ETF is not the one for you. SMH is a great way to get exposure to the semiconductor industry, and it offers amazing growth potential, and it could be a strong addition to a diversified portfolio. And if you're interested in other options for growth, I talk about the 6 best ETFs for huge growth in 2026 in this video here. Or in this video here, I talk about 7 high growth ETFs that can beat the S&P 500. If you made it to the end, thank you so much for watching, and don't forget to hit that like button and subscribe for more content. Keep on investing, and I'll see you in the next one.